If you're thinking about buying a home in Florida right now, I need you to slow down and watch this to the end, because what looks like a dream move in 2026 could turn into one of the most expensive mistakes you ever make. Florida is not one market. It's a patchwork of micro markets, each with different risk levels, different insurance realities, different buyer pools, and different downside exposure. And right now, 5 cities are flashing warning lights that most buyers either don't see or don't want to see. Not opinions, not vibes, numbers. In each of these cities, you'll find some combination of prices that ran too far, too fast rising inventory, and longer time on market affordability, breaking under mortgage rates, taxes, and HOA costs, an insurance situation that is changing the math, monthly climate and flood risk showing up as real, billable costs, and investor-heavy pockets that can unwind fast when sentiment flips. And here's the key. You don't lose money in real estate just because prices drop. You lose money when you buy in a place where the carrying costs explode and the buyer pool shrinks at the same time. That's the danger zone. That's where forced sellers appear. That's where I'll just hold it becomes I can't afford to hold it. Today, we're breaking down 5 Florida cities that are positioned for meaningful price declines in 2026, especially if the broader economy slows and buyers keep demanding discounts for risk. This is not financial advice. This is a risk briefing. The point is to help you make a smarter decision with your eyes open. Before you sign a 30-year contract based on a 30-minute open house. Let's start with the big picture, because without the macro context, the city list won't make sense. Why Florida's housing boom is losing altitude. Florida's run-up wasn't an accident. It was powered by a perfect cocktail. 1. Migration and remote work money. People moved in from higher cost states with higher incomes, bringing cash, equity, and bigger budgets. Florida's lifestyle and tax structure were a magnet. For years, demand overwhelmed supply, but the migration wave has cooled. As Florida's cost of living climbed, the "it's cheaper down there" narrative got weaker. Even local reporting has highlighted a slowdown in domestic in-migration as affordability deteriorates. 2. Mortgage rates changing the ceiling. When money was cheap, buyers could stretch. When money isn't cheap, the market stops forgiving overpricing. By the end of 2025, the average 30-year mortgage rate fell to about 6.15%, down from roughly 6.91% a year earlier, with expectations that rates may hover just above 6% into 2026. That helps compared to 7%, but it doesn't restore the 3% world. So the affordability ceiling is still lower than during the boom. 3. Insurance is no longer a footnote. It's the payment. In many Florida markets, especially coastal and storm-exposed areas, insurance has shifted from annoying to market moving. Florida has led the nation in home insurance non-renewals, and some projections put average annual premiums in the 5 figures, while also noting that costs vary widely depending on location, coverage type, and the data source used. The practical point is simple. Buyers are being forced to underwrite risk like an investor. If the insurance quote is brutal, the deal collapses. 4. HOA and condo costs are squeezing buyers. Especially in condo-heavy or coastal communities, HOA fees, insurance, and special assessments have become a serious headwind. Post-Surfside regulation and reserve requirements have pushed associations to fund repairs and reserves, sometimes through major special assessments. Even if you're buying a single-family home, this matters because it can shift demand away from condos and into homes, or away from the entire area if total monthly costs get ugly. 5. Inventory is rising and buyers are getting leverage back. This is the part sellers hate to hear. When listings sit longer, the market turns from name your price to move. And when the market turns, it doesn't politely tap the brakes. It corrects. Now, combine all of that with one more reality. Florida has a lot of investor activity in certain markets. Short-term rental, flipping, second homes. When investors retreat, they don't retreat one at a time. They move as a herd. So when the sentiment shifts, it can shift quickly. That's the setup. Now, let's get into the 5 cities. Countdown style, starting with number 5. 5 Tampa, a great city. With a market that ran ahead of its base, Tampa shocks people because it feels like a permanent winner. It's grown, it's desirable, it's got jobs, it's got lifestyle. But the risk in Tampa isn't that it's a bad place to live. The risk is that the pricing and the carrying costs ran too far ahead of what the median household can comfortably support, especially under today's rates. Redfin data shows Tampa's market has already been cooling. In November 2025, median home prices were around $418K, down 7.5% year over year, with homes taking about 63 days to sell, up from 47 days the year prior. That matters because time on market is the early warning sign. When days on market rise, sellers start cutting. When sellers cut, comps follow. Here's why Tampa is exposed going into 2026. 1. Correction risk after fast climb. Markets that sprint often stumble harder. Tampa experienced heavy demand during the boom. Now it's normalizing, and normalizing from a high level often looks like a decline. 2. Insurance is forcing a new buyer calculation. Tampa Bay sits in a hurricane-prone region. Even when premiums stabilize in some reports, the lived reality is that many buyers are, quote, shopping and getting sticker shock. When insurance feels like a second mortgage, demand thins out. And when demand thins out, price support weakens. 3. Investor pockets can flip fast. During hot cycles, investors buy aggressively. When price growth slows and carrying costs rise, those same investors can become sellers simultaneously. That adds inventory and pressures pricing. 4. Affordability is the ceiling. Even if rates drift down, the total payment still includes taxes, insurance, HOA, maintenance, and, if it's a condo, association risk. Tampa buyers have more options than they did 2 years ago. That means Tampa has to compete again. The bottom line, Tampa doesn't need a crash to hurt recent buyers. A 10-15% correction across certain neighborhoods, especially investor-heavy and insurance-exposed pockets, can erase years of equity for anyone who bought late and financed high. Tampa can still be a smart buy if you buy correctly. But if you buy like it's 2021, you're buying a story, not a market. Number 4, Port St. Lucie, the escape valve that got priced like a premium market. Port St. Lucie exploded as people fled the cost of South Florida. It became the affordable alternative. But here's what happens when a market gets branded as affordable. It attracts demand until it isn't affordable anymore. Redfin shows Port St. Lucie median sale prices around $400K in November 2025, down 3.6% year over year, with homes taking roughly 80 days to sell. Zillow's local data also shows a high share of homes selling under list and elevated inventory measures in late 2025. Longer selling times plus price, softness, plus rising inventory is the classic setup for deeper cuts when the next stressor hits. Why Port St. Lucie is vulnerable. 1. It became expensive for what it is. A lot of buyers tolerated the trade-off. Fewer amenities, more sprawl, less culture, because prices were lower. When prices rise into the premium range, people start asking harder questions. If you're paying near big city money, you want big city value. 2. New. Construction competition is real. Florida continues to attract massive development activity, including master-planned communities and a constant stream of new builds. New construction can cap resale appreciation because buyers can choose brand new with incentives. When builders get aggressive, rate buy-downs, closing costs, upgrades, resale sellers get squeezed. 3. Insurance and total payment shock. Even inland markets can face rising premiums depending on the property, roof age, mitigation features, and broader underwriting shifts. And if rates remain around 6% plus, the total payment is still heavy. 4. The buyer pool is more price sensitive than people admit. Port St. Lucie draws retirees, remote workers, and families looking for value. Those buyers are very sensitive to monthly costs. When insurance, taxes, and maintenance rise together, the value proposition weakens and demand slows. If you're buying here, the key is not the purchase price. It's whether the monthly carrying cost stays rational when insurance renews and taxes reset. Sobre 3, Punta Gorda. Where storm risk isn't theoretical anymore, Punta Gorda is beautiful. It attracts retirees and people who want quiet coastal living, but quiet doesn't mean safe financially. This region is exposed to hurricane and flood risk in a way that directly impacts insurance availability, mortgage eligibility, and resale demand. Hurricane Ian's impact in Southwest Florida is still echoing through payouts, underwriting, and buyer psychology. Redfin data shows Punta Gorda's median sale price around $420K in November 2025, but the bigger signal is time on market, about 106 days, up from 61 days the year before. And when you zoom into certain neighborhoods, the risk becomes clearer. For example, Redfin shows Punta Gorda aisles with a steep year-over-year decline and very long days on market in late 2025, why Punta Gorda is a high-risk market into 2026. 1. Insurance and financing friction. If insurance is hard to secure or expensive, buyers struggle to qualify. If buyers struggle to qualify, sellers cut. If sellers cut, comps slide. 2. Retiree demand is not infinite, and it's cost sensitive. Retirees care about stability. They don't want surprise expenses. They don't want rising premiums. They don't want major special assessments. When costs become unpredictable, many simply choose another market. 3. Storm history changes behavior. After major storms, buyer behavior shifts. People ask different questions: elevation, flood zone, roof age, mitigation, drainage, claims history. That's a higher bar for sellers. 4. Longer days on market create a pricing cascade. When homes sit for 100 plus days, sellers don't just wait. Life forces decisions. That's when you see meaningful price reductions. Not because people want to sell cheaper, but because they need to sell at all. If you're buying in Punta Gorda, you don't buy the postcard. You buy the math: insurance, flood risk, mitigation, elevation, and exit liquidity. 2. Lakeland. The affordability story that's getting strained, Lakeland surprises people because it's not a beach town. It's not a luxury coastal market. It's been marketed as the smart, affordable middle between Tampa and Orlando. That's exactly why it's on this list. When a city becomes the overflow valve for expensive metros, its prices rise faster than its local fundamentals. Eventually, the affordable alternative becomes just expensive. Redfin shows Lakeland median sale price around $278K in November 2025, down 5.7% year over year, with homes taking about 55 days to sell, up from 43 days the year before. So what's the risk? 1. It's heavily tied to commute economics. Lakeland works when the commute trade-off feels worth it. But longer commutes, traffic, fuel costs, and lifestyle friction eat away at the affordability advantage. 2. It attracted investors hunting yield. In many mid-market cities, investors bought aggressively during the boom. When rent growth slows and financing stays expensive, those investors become sellers. That increases supply. 3. Affordability is still under pressure with rates near 6%. Even at lower price points, the monthly payment matters. A small rate shift doesn't rescue a buyer who's also facing higher insurance, taxes, and repairs. 4. Buyers have more options now. When the market cools, buyers get picky. They start demanding move-in ready homes, clean inspections, and price reductions. Older housing stock and repair needs become real negotiation points. Lakeland can still be a solid long-term play. If you buy below market, negotiate hard, and don't stretch your budget. But if you buy at peak pricing expecting quick appreciation, you're playing a different game than the market is offering. Number 1, Cape Coral, the most obvious perfect storm setup. If there's one Florida city where the risk factors stack on top of each other, it's Cape Coral. Cape Coral got caught in a boom cycle of pandemic migration, investor speculation, and lifestyle demand. But it's also a market where flood exposure, insurance volatility, and infrastructure realities can hit values harder than people expect. Redfin shows Cape Coral median prices around $370K in November 2025, down 5.1% year over year. Zillow's home value index for Cape Coral shows a significant decline over the past year, with longer pending times and weakening demand signals. Now add the bigger issue, risk and cost. Southwest Florida communities, including Cape Coral and Punta Gorda, saw massive flood impacts tied to major storms, and that reality flows directly into insurance markets and buyer perception. PreventionWeb.net. Why Cape Coral sits at the top of this list. 1. Flood exposure is a market lever. Cape Coral's geography and canal system are a defining feature, but in storm events, those same water dynamics can become a liability. Flood risk isn't just a concern, it's a policy quote, an elevation certificate, a lender requirement, and sometimes a deal breaker. The city itself emphasizes flood insurance requirements in certain zones and availability across zones, reflecting how central flood considerations are in this market. Capecoral.gov 2. Insurance pressure shrinks the buyer pool. When insurance becomes expensive or unstable, buyers either demand discounts or they leave the market. That reduces liquidity, especially for properties in higher risk areas. 3. Investor unwind can accelerate declines. Speculative money moves in fast and leaves faster. When investors see prices flatten and carrying costs rise, they list. More listings mean more competition, and competition means price cuts. 4. The market is already signaling softness. Falling values, longer pending periods, and reduced buyer urgency show up in the data. That doesn't mean Cape Coral is over. It means the leverage has shifted. Cape Coral is the kind of market where the wrong purchase, especially in a high-risk zone with high insurance and limited resale demand, can trap a buyer. Not because they can't live there, but because the exit gets expensive. The real lesson: don't buy Florida with 2021 assumptions. Now listen carefully. This isn't a statement that every home in these cities will collapse. Florida is local. There are strong pockets, weak pockets, and streets that perform differently even within the same zip code. But these five cities, Tampa, Port St. Lucie, Punta Gorda, Lakeland, and Cape Coral, are showing the kind of early warning signals you ignore at your own risk. So what do you do with this? Here's the buyer's checklist for 2026 survival. If you're buying in Florida, you don't just ask, is this a nice house? You ask, 1, what is the total monthly cost? Not the mortgage payment? Get real quotes for homeowners, insurance, flood insurance, if applicable, taxes, current and projected, HOA fees, and HOA financial health maintenance and reserves. 2, can you still afford this if insurance rises at renewal? Run a stress test. If your premium increases 20, 40%, are you still comfortable? If not, you're buying a fragile deal. 3, how long are homes taking to sell in that specific neighborhood? Days on market tells you leverage. Rising DOM means you negotiate harder, or you wait. 4, are you competing with new construction incentives? Builders can undercut resale sellers with rate buydowns and upgrades. If a builder is offering incentives nearby, resale prices can get pressured. 5, what's the exit plan? If you had to sell in 18 months, could you? At what price? In what market conditions? Liquidity matters more than people think, because the truth is, the market doesn't punish people who buy homes. It punishes people who buy homes with fragile math. Final recap. The 5 markets most exposed into 2026: Cape Coral, Lakeland, Punta Gorda, Port St. Lucie, Tampa. If you're considering any of these areas, you don't need fear. You need discipline. You need numbers. You need patience. Because the man who wins in real estate isn't the one who buys fastest. It's the one who buys smartest. When the math is undeniable and the risk is priced in. If you made it this far, you're serious about protecting your money. Subscribe for weekly, data-driven market breakdowns, specific cities, clear warning signs, and zero fluff. And drop a comment. Which city surprised you most? And what are you seeing right now with insurance, days on market, and price cuts where you live?